Money conversation that pays a big dividend. The WBBM Noon Business Hour continues.
Walt Disney is announcing job cuts and a renewed focus on its core brands and franchises. Let's discuss this restructuring with Tim Hanlon, founder and CEO of the Vertere Group based in Chicago. Tim, thanks for joining us today. 7,000 jobs will be cut by Bob Iger as he returns to Disney after the tenure of CEO Bob Chapek. And it should be noted, Tim, that the 7,000 employees who are being laid off, it sounds like they were all part of that special operations section, for lack of a better word, that Bob Chapek had formed during his brief tenure as CEO.
Yeah, I mean, this is essentially a rethinking of the previous rethinking of how all of this should be structured. In essence, what Iger and his team have done is to kind of reset some of the changes that Bob Chapek had put into motion to somehow streamline the advent of streaming becoming a more important part of the overall dynamic. Some would argue perhaps overly so and perhaps a little premature given that it's still very much a loss leader streaming is. But in essence, you've got now three newly defined or redefined or maybe revisited divisions, three groups that are a little bit more firmly defined, and to the inside, Wall Street type might be a better situation for potential spinoffs and or pieces down the road should they need that strategic option.
Let's talk about Disney Plus, because Bob Iger has said that streaming is the future. It definitely there's growth in streaming, but the profits just simply aren't there yet. And what does this mean not only for ESPN, which has its own standalone division in this new structure, but what does that mean for ABC and for broadcast television? How do they fit into this vision for the future? Because people still watch broadcast linear TV. I mean, it's not very sexy, but the viewers are there, the profits are there, and it's something that streaming is yet to achieve.
Yeah, it's a really good point. And in essence, this is a balancing act that, essentially it's stuff we've talked about before, where the linear television models, cable and broadcast and feeds that come with all that are still pretty darn good at scale and are still the relative majority of how people access television. The reality, though, is that is declining for various reasons. And streaming, obviously, is growing in leaps and bounds. But the profit margin in streaming is far less. It's the proverbial digital dimes for linear dollars trade-off kind of thing. And I think the reality is that it's really an exercise in what we would call managing decline, right? And the decline is the linear television business. Now, that doesn't mean it goes away. But it has to be de-emphasized in some respect, knowing that the other part is growing, that is streaming. Look, Iger went out of his way yesterday to say that ESPN is a differentiator for Disney. And live sports thing, Fox knows this too, right? Does very, very well with that live sports thing. And the Super Bowl, as we see next week or this weekend, is another piece of evidence where you're going to get 100 million eyeballs watching that game. So that said, ABC is a broadcast television network. I'm not sure. I think lots of things are on the table for Disney strategically to potentially get rid of. That could be one of them because it is a lagging kind of asset. I think, frankly, Hulu could also be in the conversation about being sold or spun off too. So lots of pieces to manage up that overall decline.
Tim Hanlon, founder and CEO of the Vertere Group based in Chicago. Thank you for joining us today.